presentation contains current opinions of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that those opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation.
Hello, everyone, and welcome to the Compak Market Wrap Update for July 27th, 2026. I'm Moe Javaid, President of Compak Asset Management, joined by Javaid Ansari, Executive Vice President here at Compak Asset Management. Thank you for joining us today. Housekeeping note, click on the subscribe button so whenever we post an update, you'll be notified and you can watch it at your convenience. If you need help with your portfolio, just send us an email at invest@compak.com or just give us a call at 800-388-9700. And thank you, everybody that came to the book launch at University of California, Irvine, the business school there, the Paul Merage Business School. It was a wonderful event. Thank you for so many of you that came to the event, the launch, and it was a lot of fun. And it is a great book by Feroz Ansari. He's also an adjunct professor of finance at the University of California, Irvine, and Wisdom and Wealth Solution. We've got a special YouTube channel now that you can go to Wisdom and Wealth Solution and just click on the YouTube channel and you can get the first 2 episodes discussing the book, the cores of the book, topics, and also some discussions by Feroz. I think you'll find it really, really enlightening. That's the way I would look at it. It just gives you a good idea of how wealth gives you happiness and how to create happiness with wealth and how to combine wisdom and wealth. And if you would like to get the book, just go to Amazon.com and you can order the book there directly to you. Let's start with the numbers. Looking at the numbers, not a good week last week.
Yeah, S&P down 1.66%, Dow down 1.58%, Russell down only 1.15%, growth stocks taking another hit down 2.1%, EFA holding up relatively well. It's a little surprising given that oil prices were up dramatically last week with the kind of escalation with the Iranian conflict, but EFA only down 0.83%, emerging markets up 0.5%, and NASDAQ down 2.88%, almost nearly 3%. So what we've seen here just recently over the last, I would say just kind of back and forth now since May, has been a little bit of rotation. We highlighted it in our quarterly update with our clients last week as well, which we do specifically for Compak clients, where we've seen the Magnificent Seven take a little bit of a breather, and we've really seen the other 493, once again S&P 500, the other 493 still looking relatively impressive and up for the year. So a lot of the big gains I feel like in the Magnificent Seven have been kind of captured. Now they're having negative free cash flow as they're investing in all of this AI infrastructure. And the really beneficiaries, hopefully now the market's starting to price in from AI and the AI productivity gains, is these other large S&P 500 companies. They're the ones that can use AI to hopefully increase their profit margins. And so far, that's what we're seeing in the earning projections.
Energy was up last week as crude oil prices jumped up again. And I think this week we have a pause. I think both sides are just exhausted. The Iranians are getting tired of getting bombed, and the U.S. is sort of running out of missiles to protect its bases. So I think both sides are sort of saying, okay, for right now, we've had enough. It's like 2 boxers just boxing it out and finally just running out of energy. And that's what is happening now. What is the long-term solution? We'll have to wait and see which way this whole thing goes. But energy prices are down sharply today, and that has brought, I think, the rest of the market up. Communication services was down last week big, and consumer discretionary was down last week also. But this whole Iranian conflict seems to be sort of at a pause right now, but also seems to be expanding after Ukraine launched some strikes in the Caspian Sea. Seems like Ukraine is getting entangled in this war with Iran and the United States and Russia and Ukraine. It's all becoming a big mess overall. So how is this going to get resolved? And maybe it all resolves itself very nicely and everything works out nicely. We'll have to wait and see.
Yeah, I think, with the U.S. particularly now potentially running out of some munitions, that's going to slow down the conflict. I don't know if it actually leads to any sort of opening up of the Strait of Hormuz, because that's basically the leverage point for Iran in the whole situation, and now maybe applying that also to the Red Sea. So I think it just kind of meanders. I'm just happy to see that even though interest rates have risen, the market hasn't really had a huge effect on the market. Some of the go-go trades, semiconductor stocks and those DRAM and those other type of trades have definitely pulled back, but they were also up the most for the year. And so I think when we look at, we'll get some more, we have a Fed week this week. So inflation, growth, employment, all of those are on everyone's mind, as well as earnings. So a big week for new economic data. But when I look at the underneath the rise in interest rates, yes, I think there is some component of clearly higher oil prices. Oil hit almost over $100 a barrel last week. Yet when I look at the inflation expectations, they haven't really risen. And so, interest rates have been kind of meandering higher, but potentially, you also have to look at they're going higher because we're expecting more growth as AI productivity really starts to feed into earnings and companies going forward. So you can't rule that out. Once again, that's why I like my high yield indicator, because that's throughout all these different episodes, it's still remained relatively in the positive direction. And economically, things still look pretty good. Also, the employment jobs number came out. Some unemployment numbers we get every week, but the job market looks pretty healthy. And so when the job market's also really healthy, that can also have some slight upward pressure on interest rates. But that's a good thing. We like a really strong job market.
But rates are not they've gone up a little bit, but not to a point where it would be of concern. That's the way I would look at it. And everybody is talking about, the Fed is going to raise rates in July. Well, now the expectation is they're not going to do anything on Wednesday. This is the second meeting the Warsh is going to chair as the chairman of the Federal Reserve. Again, no interest rate increases are expected. So again, as I've said, I don't think rates are going to go up by the end of the year. Everybody was expecting 2 interest rate increases, then they came back to 1, and now they're saying, maybe we are going to get them, maybe not. I don't think, especially if energy prices come down, they'll take a lot of pressure off the inflation number, I think, overall. But inflation is demand. It's the economy that's doing well, and that's why rates have sort of crept up a little bit, but not to a point that they're a point of concern.
Yeah, I think interest rates are always something we monitor really closely, but I think it's just overall oil prices. I know those can fluctuate a lot, but as we talked about back in the beginning of the Iranian conflict, really it's going to take national gasoline prices, because once again, oil goes into gas, and then people are transporting everything. It kind of can inflate all the prices of everything else, transportation costs. Unless we get above $4.50 per gallon on gasoline nationwide. California, I know we're there. We're going to be there probably in perpetuity. But unless we get into above 4.5, and really 5 is kind of when it could, I think, really start hurting everyone from a recessionary standpoint. But I was just checking last week. It's still at, I think, $4 a gallon across the nation. So I think we see a slightly upward pressure, not great during the peak driving season over the summer holiday, but overall the market seems to be taking it in stride.
And that's the good part. Oil, as we can see, was nearly $100 a barrel.
You can see the gasoline right there as of July 23rd, right at $4.
$4 a barrel.
So unless that gets, a gallon. So unless that gets to 5, really still we're dealing a lot of the stimulus effects of the OBBA and the tax revenues. Tariffs have kind of come back into the fray a little bit in terms of different types of tariffs, but generally the whole retaliatory tariffs that we saw, tariff tantrum, those level of tariffs are off the table. And so I think generally I'm still a big fan of taking advantage of these higher interest rates. If you have a lot of cash, I think now's a good time to elongate your duration or your maturities, buy some bonds going out 3, 4, 5, 6 years, lock in these rates, and capture this interest while it's here.
Look at it, it did jump up from 4.57 to 4.71 last week. And that's, I think, more of a oil going up as much as it did last week. So today we're back down below 4.7. We're down to about 4.6 and change. So I think, again, rates are just fluctuating. As long as they're below 5, I think it's not a big deal. This is, everybody has been getting very concerned about the AI build out, how much money all these companies are putting into AI and building these data centers and buying these chips and so on. But you've got to put it in perspective when you look at the huge infrastructure build outs in over the last 150 years or so. You look at that and you look at what percentage of GDP was going into this build out. You can see that it's here we are right here on the left-hand corner.
Yeah.
That's where we are, 1.5% of GDP compared to 3 times as much or nearly 2.5 times as much when we had the railroad build-outs and so on in the 1880s and the electric motor in 1920s and so on and so forth. So when you look at all of this build-out, it is a lot of money, and some of these companies now are starting to get into negative cash flow. As I was talking about last year, that all this money was coming from cash flow. It was not being borrowed to be put into AI in data centers like it was in the .com. Everybody was borrowing money and saying, okay, we're going to do this .com thing, this internet thing, and it's going to create all this stuff, but it never got done. So now we've seen that the companies have spent money, but now companies, a lot of people are saying, okay, wait a minute, you put all this money in, let's now see the ROI. Let's see the return on this investment. Where is it going to come from? How much is it going to be? Is it going to be enough? Is it going to justify this investment?
And that's why I think we're seeing a little bit of rotation in the sense that I don't know if there's going to be as big of ROI as everyone's anticipating, yet it doesn't mean the market's going to go down. Because if there's a rotation and the actual companies themselves, the other 493, they get an ROI. They didn't have to do all the build out, but they're getting the benefits of AI, right, to continue to expand their profit margins. And I thought that was one of a cool chart we did on the quarterly update. Once again, you have to be a Compak client to get all the best charts. But if you want to, one of the good charts I liked was looking at the profit margins of the tech companies.
Right.
Those were 20% plus.
Right.
And then if you look at the profit margins of the others, they were in line with the S&P, still in kind of the teens, right? And so around 16. And so the profit margins now are starting, I think, to transfer from the tech companies to the other companies. And I think that's, a very positive sign. That's why you're seeing small cap companies, mid cap companies, the other, companies within the S&P 500 do very well. And that's actually our chart right here. And once again, if you're listening on the podcast, you can check out these charts on our YouTube channel. Just go to YouTube, type in Compak Market Wrap, and the YouTube channel will pop up. Don't forget to hit that subscribe button. But this weekly chart also just shows where, back in 2013, 2014, all the earnings momentum was on the Magnificent Seven. But since 2025 or so, and specifically getting into this year, you look at these orange columns here, they're now larger than what we're seeing in the Magnificent Seven. So that's all a positive type of development where we're seeing a broadening out of the market. And will AI allow, is there going to be a bigger disruption, right? Everyone's so enthusiastic looking at all the positives around AI. The profit margins going up, more earnings, yada, yada. It's all great. But then we see these things with OpenAI, right, getting out of its closed box and
hacking. One of them got away and attacked another company.
Yeah, went rogue. And so, then, there's also the negatives around AI and potentially the job blowback, the political blowback. Now politicians are saying we need to have a kill switch, where if this AI does get out, we just need to be able to unplug it. And clearly that would make a lot of that $700 billion in investment go up in smoke.
Plus, it could make AI really angry.
You can't be angry if it's not on. But,
you don't know. It might plug itself in. That's the thing that worries me, as you know.
And the other thing we also talked about was Chinese AI and these open weight models, which are not as profitable. Right, the frontier models, and the Anthropics, the OpenAI, ChatGPT, all of these, Gemini, even these more kind of frontier models, they're closed, and, they're proprietary to the AI companies. But then you have, I don't know if everyone's heard of, it's called Kimi K3. It's the top. It's kind of like the DeepSeek Chinese OpenAI model. And so that was the one that actually kind of helped the company fight the hack that was happening because of OpenAI. And so those aren't, as I would say, monetize. You can't monetize those as well because they're open. Anyone can develop them, use them, and going forward. So we'll see. We got the initial data from Google and Tesla last week. Their earnings came out. Stocks were down big, but revenues were still good. Earnings were still good. It's just the market's getting a little concerned about the level of this negative or the burn of the free cash flow. I think they're starting to signal to the market. The market's starting to signal to these companies, hey guys, maybe kind of pull it back a little bit, slow it down a little bit. Yeah, we get it. AI is the future. It is going to be revolutionary, but we need you guys to kind of just keep everything somewhat in mind. And so, this week we have Microsoft and Meta. They report after the close on Wednesday. Apple and Amazon are on Thursday. So we're going to get a lot more data here. So I have a feeling we're going to see just a lot of choppiness, along individual stocks, but the overall kind of S&P, once again, because we are seeing earnings across the other 493, still remains somewhat subdued.
This is interesting. It's the third and fourth quarter of this year. It's expected that the earnings for the 493 companies in the S&P 500 are going to surpass the Mag 7. That's in blue. So the first time since in the last 3 years, we're going to see the 493 outpace the Magnificent 7.
Yeah,
so that's going to be interesting.
And when I look at earnings, one of the indicators I look at is the 3-month forward revenue and earnings. And right now, 90% of the S&P 500 has positive forward revenues and earnings momentum. So you're seeing a broad swath of companies that are doing very well, right? And anticipating to continue to do well. And so when you have that momentum, that momentum's tend to stay for a period of time. It doesn't, you don't have 500 companies all of a sudden say, oh my God, we blew it. We're in a recession. These are a lot of different companies. So
As I say, the more money a company makes, the more valuable their stock is. It's that simple. This week we get, there's a Fed meeting on Wednesday, and they're going to announce any changes in rates, which is not expected. But it's going to be interesting to listen to Warsh's
press conference
after the meeting. That's going to be good. We get consumer spending sentiment comes out, expected to be 54.
This is last week.
Last week, and we had PMI at 53.6 last week, which is, again, above 50, shows expansion. So all the numbers are very good. They're coming along good. This week, we get a lot of data. We get the PCI.
PCED, so the kind of inflation type of gauge comes out on Thursday. There's a bunch of Fed, not only the Fed is meeting, U.S. Federal Reserve, but you have Japan, some other, I think UK is also meeting this week. So we're going to get a lot more kind of macroeconomic interest rate data, plus the earnings. So just kind of a lot to digest, but it just kind of seems like the market is, just taking it in stride. I think everything's good. We're getting good earnings, but at the same time, because things have ran up so much, we showed a chart, I think it was last week, of the 4-year rallies that we've seen since 1928, and this is the best. So when things go, and that's why we invest. We don't get scared when things are really good. But when things are this good, you just have to be a little bit kind of, there's going to be some digestion and just consolidation, but hopefully things continue.
That's as long as it's a rolling correction, that it just rotates out of one sector, goes into another sector. I'm perfectly fine with that. As a matter of fact, that's healthy. Looking at the market overall, we've just gone sort of sideways since the beginning of June. Last 2 months, we've just gone back and forth, back and forth, back and forth.
A little concern there with maybe the moving averages crossing over?
Yeah, the 50-day, it was just so far, the 20-day was above the 50-day by so far that it's come close, and now it's broken below it today. As a matter of fact, it's down. So we're looking at this breaking below the 50-day, but it has been gapped down here on Thursday, the market did last week. But as long as we're above this, which is 7,300, we're just in this range going back and forth between 76 and 73. It comes down to the bottom, and that's the fourth wave. As I've said, they are classic choppy waves, one way or the other. If you get the settlement in the war in Iran, we could just break out and take off to the upside. So this is third wave. Fifth wave should be somewhere around here, 7,700 to 7,800. Once we break out above this all-time high that we made at the beginning. So last 2 months, gone nowhere, just back and forth. Same thing with the weekly chart. We're stuck in a very tight range between here and here. Again, the same thing, 7,300 to 7,600. This is support. 72.33 is the 20-week moving average. As long as we're above that, I think we're okay. But now, this is an interesting chart. The next one, the weekly chart, the dot plot.
No, the dreaded dot
The
plot.
dreaded dot plot.
So we talk. You have the Fed dot plot, and then we have Moe's dot plot. So I follow Moe's dot plot closer.
This is the one that it's fourth wave pullback. We've come down here to 1, 2, 3 times. And today now we're at the bottom of the range again. But that's, again, typical fourth wave, back and forth, back and forth. Still a good chance we're going to break out above the high that we made at the beginning of June. But we need to get above 26,000 for the NASDAQ, and today we're at 25,000 plus or minus. So we need to get above 26 and really get going. The weekly dot plot, it is coming up. You can see the dot is right here now. And when the market gets below this dot, that's not a good sign. Usually for 4 to 6 weeks, we're down pretty hard, as you can see here, that we came down at the beginning of this year.
So that you did the weekly, so it was 23,847. So let's just round it, 24,000. If the NASDAQ gets below 24,000, right, then the dot plot turns negative.
Negative. So 24,000 is the number I'd watch. We're 24,000, really 25,000 today. So we need to stay above 24,600, 23,700 is really the number.
But really, then if we maybe get below that, then we potentially see a bigger correction.
Yeah, then
in
it
the
can come down to
S&P.
the 21,000.
Yeah, and then clearly, now, and this is one of the things that we talked about. We've been kind of ad nauseum talking about diversification. S&P 500 used to be a nice way to diversify. You had the S&P 500. Traditionally, the top 10 companies in there was like 20%. Well, now because these tech companies have grown so much, they're 42% of the S&P 500. So if you're buying the S&P 500, you're still putting half of your money into 10 stocks, and primarily those 10 stocks are all tied to AI. So I think now is a good time to really kind of think about the other 493, number one. There's some ETFs out there that actually exclude the Magnificent Seven, and those have actually done really well. Equal weight ETFs are also in that camp as well. But you can think about mid cap, small cap, international. China, international, when it comes to China, I was looking at emerging markets. I still think China is in a tough spot. You look at their property bubble, it's still busting. They have a lot of leverage, associated with that bubble. So the Chinese companies, they've bounced recently, but I'm not a big fan of them. But, I think other, emerging markets, potentially look good, other international. So the more, diversification, also I think private equity, more market, different types of companies than just, public companies also make a lot of sense with these interval funds. Now, if you're an accredited investor, you're able to get access to these funds. So I think diversification is really the key. And that just kind of goes back to the NASDAQ, whereas the NASDAQ is leading to the downside. That's tech, primarily tech, right? And so it looks like the trend doesn't look great. It's holding in there. But with those fifth wave tops on the NASDAQ, potentially having a little bit more diversification among your equity exposure is probably something to consider.
So what you're saying is for the rest of the year, diversification is going to be the watchword.
Yeah, not risk off yet.
Not risk off, but diversification, not being all in tech.
Correct. Everyone kept doubling up and getting the semiconductor stocks, and I need the DRAM, and I'm going to put half my portfolio into SanDisk. Well, or even take it to the next level, put it into SpaceX. I haven't checked SpaceX today, but
good.
I think it's below the IPO level.
Oh, definitely below the one. It's down to 115 today.
Is it?
Yeah.
Some smart people were saying maybe take a look at it at 90, but really, I think with those type of speculative companies, you're just really picking numbers out of thin air. Or space in this particular case. But 114, it's closed at 113. Wow, it is
Really taking a beating. Even though they had the rocket launch on Friday and went really well. They're big rocket.
Well, the thing is that with these IPOs, everyone got all excited. Oh, look, I'm getting in. Well, the problem with the IPOs is everyone else is getting out. All the smart money that's made all the money, they're now going to continue to issue more shares and dilute the earnings per share of your investment over time over the next year. So until they all get out, you hastily have this kind of downward pressure, potentially on the stock going forward, and then things will settle out. And it is SpaceX, it is the future, it is the only way to get things into the orbit. So there is some definitely tangible value there, but we'll see where that fundamental value is once things have really kind of settled out. Once all the shareholders have been able to execute the
August
shares.
4th is going to be interesting. That's when the first batch is going to be released that they can sell. The insiders can sell. So that's just coming up in a few days. So we'll see what happens. But I was looking at SpaceX at $90, as you were saying. SpaceX is really valued at nothing. It's just Starlink.
Okay, great. I like buying something
That's making money.
Yeah,
that's the only
that's
part.
making money, and I'm not paying a price for it.
Yeah, and then you get SpaceX basically
For free.
for free, which is, I think, somewhere in the future, if it starts making money, could be really good. Small cap, still looking good, holding its own, not going anywhere. It was even up today, so it's looking okay. This is a weekly
And this is, I talked about it a little bit last week. The fact that small cap is outperforming is also kind of tells me that maybe interest rates aren't headed to the moon. Because if
Right.
interest rates were going to go much higher, everyone's worried about, oh my God, inflation's coming, inflation. Small cap wouldn't be rallying because these companies are very sensitive to the interest rate environment. So this kind of is an equity market that also kind of feeds into our projections that interest rates are going to be somewhat subdued here going forward. So that's good.
international markets sitting right at the 20-week moving average. The red line is a 20-week. We came and kissed it for the last couple of weeks, and today we're a little bit above it, but still a third wave. Fourth wave, messy, back and forth, and I think that's where we are with this. Everything going sideways. Oil prices went skyrocketing, hit this very close to this high that we had made in May.
Because he said he was going to, just decimate Iran, and then now I think his generals are saying, "Sorry, sir, we don't have the missiles to decimate the place." And so that actually, that information was probably good for the market, where they know, okay, it's not going to potentially escalate in the future, just because we just don't have the ammunition to do it.
And this is a gap up, island top, and gapped up, gap down. So today, big down day in the market here. In oil, so 8.5% lower for the DBO. That's the daily chart. Again, just back and forth, up and down. Just depends what the headline news is, and nobody can predict that. Again, weekly chart, we got to get below 20 now. That's the number. And
Like I said, 19 is kind of my 19. The conflict's on. There's no resolution. Things. We don't want to see things break out to all-time highs. But as long as it's above 19, it's just kind of one of those things that you're going to still hear about in the news on an ongoing basis. So hopefully things can break down at some point. But I don't think they will. I think energy. We saw energy up a lot last week. I just don't see a big resolution coming out of this. It's just kind of gotten into a little bit of a stalemate. I think it's going to potentially hurt. I think the Republicans in the midterms. I think we're only 100 days out now from the midterms. So we'll see. How that all plays out. Which is, market I think is also okay with that, as there's maybe a little bit of checks and balances on the Republicans. So. We'll see how it all plays out, but I'm not optimistic that this thing's going away anytime soon.
The Iranian situation looks like it's just a stalemate right now. Nobody wants to give in, nobody wants to get out. So it's sort of, as I said, it's like a Texas rainstorm last week. You can't hide from it, and you can't get away from it. That's really what it is. So, and you can't stop it. So this is interest rates. We gapped up on Thursday, sharp move up here, gap right back down. And today we're at 4.64. We hit this high of 4.7. Yeah, just if you get below 4.6, that would be good. That's the 20-day moving average, and then 4.52 is the 50-day moving average.
I would only, and once again, this will dovetail right into our high yield chart. I would only be concerned, if interest rates are really going up a lot, and we're starting to see growth expectations come down. We're going to get GDP numbers later this week. It's going to be about 2%. Everything else looks pretty good. So HYG is still relatively, to AGG looking great. Gold chart, gold is in a tough spot. But if you look at this chart here, you can see while bonds, AGG's come down recently throughout July, the green line, HYG's held up really well. And so at some point, if interest rates, I think, go higher, right? Bonds will still go down, of course. But I think HYG will also come down, maybe even at a faster rate, because now they're starting to say, we're at that point where higher interest rates could really start to hurt the economy. And we just haven't gotten that yet. I think we're in a good spot where interest rates aren't too high, they're not too low, and so we're able to really, handle them going forward. So this is a key chart that we'll continue to watch.
This is government bonds, the green one. When interest rates go up, this green line comes down. And these red line is the high yield bonds. You can see they are not coming down as much as the green line is. So the relative difference between the two is still good. But when this starts to go down faster than the green line, that's not good.
Well, or the green line starts going up a lot. I mean, if the green line, I think, is, once again, interest rates are going higher, and HYG is coming down, which we've seen in the past. I mean, we saw it earlier in February and March where interest rates went up, and then HYG was also coming down. But it's just, I think it's a really good indicator. Credit spreads are at record tightness, so it's not going to take a lot for the high yield bond market to get jumpy. And so as long as it's not jumpy,
it's a good sign.
It's a good sign.
Those are our thoughts. Those are observations. Don't forget to subscribe to this channel. Click on the subscribe button, or just go to compak.com/YouTube, and you can get all the charts that we just talked about. If you need help with your portfolio, send us an email at invest@compak.com, or just call 800-388-9700. Those are our thoughts. Those are our observations for this week. We will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors, because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.